Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding. Thank you so much for tuning in here today. I am sitting alongside Geoff Gannon. Jeff, how are we doing?
I'm doing very well, Andrew. How are you doing?
Doing great. We hope everyone is doing great as well. If you have not signed up for our new app, you definitely should. Go to focuscompounding.com/app, in which you get access to is our 250 plus episode backlog of the podcast, as well as an additional episode that comes out on the weekend that is a premium only podcast. In the past, we've talked about the Playboy SPAC. We usually talk about stuff that's going on in our investing lives, kind of more of a free form show. We sort of go wherever we want to go with it, and it's a lot of fun. It is usually always longer than about 30 to 40 minutes. So to get access to that, go to focuscompounding.com/app. So in today's podcast, we're going to talk about free cash flow plus growth, investing the Warren Buffett way. And the reason I wanted to bring this up is we actually just met with a podcast listener yesterday for breakfast. And one of his questions he asked was on valuation. And I thought this recent this recent post that you wrote up for the premium site at Focus Compounding really, I guess, demoed out the way that you tend to think about valuation. A very much a simple form. We were talking about Hingham, HIFS. It is a bank, and you were just walking through different valuation scenarios with this company. And basically, it's kind of like you worked your way backwards. So you have this right here. You said, how close can this company get to returning 17% a year over the next 15 years? And you were walking through different scenarios.
What a 10-bagger is.
Absolutely.
So that's rounding things off. It's just 17% sounds like a weird number, but people are like, could this be a good enough investment? And I say, okay, well, take 15 years. That's a long period of time. Take 10 times. That's a really big return. So is it at all possible? Is this like a growth stock or whatever you want to call it? Can you get 17% a year over 15 years?
And you worked backwards. You said dividends can add 1% a year based on what it's recently been. You said multiple expansion. So it's currently trading at like a 9 PE. And you said, if it goes on a forward basis, if it goes to 15 over the years, I can add 3 to 4%. So right there, we have a 4 to 5% return. And then you were talking about where you can get the other return from, and it would have to come from the actual business generating the returns. And
so that's a really big hurdle, right?
Yeah.
So the other things are easy. The yield is okay, not great. The PE expansion is very helpful. But then you have a huge gap. If you want a big return, it really has to be a growth stock. So you have to convince yourself, is this business really capable of growing a lot? And you did it by working backwards. Exactly that, right? Because like if it was a super deep value stock, it wouldn't need to grow. And if it had a really high PE, it would need to grow even faster than 10% a year.
So you said now we need compounding of about 10% a year. And then historically, this company has compounded at 15% per year for a very long time. So you just sort of walked through, I guess, that process, how you typically think about it. Very simple, right? You spend more time worrying about the actual business itself, but I just thought that would be a quick thing to sort of go over before we look at a bunch of different companies. So what I wanted to do, people seem to like when we pull up the Quick FS Excel files, the historical financials, and really look to sort of reverse engineer stuff, like what we did with the 100-bagger episode. So for this one, I want to pull up past investments that Warren Buffett has made and just see if we could take anything away from it, see what he was looking at, see if there's anything that we could reverse engineer from it, and just kind of go from there. So we're going to look at Procter & Gamble, which he invested in 2005. So we will pull that up.
Did he actually buy shares in 2005 or did Gillette merge into it?
I'm not sure. I thought I had 2005, but let's see what.
Okay. Well, he was a big shareholder of Gillette, and Gillette and P&G merged using stock.
Oh, so maybe this would not be as...
Gillette's, not anymore, but Gillette historically was a much stronger business than P&G. And I bet the merger was sometime in the early 2000s.
Okay. So then maybe that one is not as useful.
I could be. Maybe he bought stock in the open market.
But this is 2005 right here.
Okay.
So the current, it was trading 18 times earnings. The market cap was 130 billion. Revenue was on the rise.
Yeah. Let's see. Yeah, it was on the rise and stuff then. I don't know all the details about how much of that mix and stuff is Gillette versus other things. I don't know when the Gillette thing happened. I really don't.
Got it. When you think about free cash flow plus growth, though, I mean, what is it? Because it's like, I think if you think about sometimes when a company's generating free cash flow, it could be because, and you've spoken about this before, they all generate a lot of free cash flow right before they're about to go bankrupt. So it's like, what's the difference there, in thinking about like a company actually generating free cash flow and then thinking about the future growth that it can have?
I mean, the idea is that you need to get paid one of the two ways. Buffett talked about this with like, he gave an example of Cisco or something, but basically it's the same idea as you have in a DCF. You have a discount rate, right? So DCFs like to use discount rates. But the idea is the same, which is that if you're not getting paid today, you have to kind of collect interest on that in place of it. And your interest is in the form of the compound interest that you're getting is in the form of growth. So you can put off collecting cash today to get growth tomorrow. And then let it roll over that way. You're just kind of rolling over your interest and getting more free cash flow in a future period. And so it doesn't matter to me which you get, to be honest. Theoretically, I mean, for practical reasons, I think it does matter because I think some are more predictable than others, are safer than others. But if I bought a stock that was going to grow 10% a year forever or going to pay me a 10% free cash flow yield now, I would see them the same way. Now, that's theoretical. Practically, it is difficult to be very certain that a business will continue to grow very far into the future at rates as high as 10%. It's not impossible, but it's very, very hard. And so there's a difference. But I don't think that it matters that much, except for I think that doing the calculation of free cash flow yield plus growth theoretically is the correct measure and the easiest measure, and a better measure than doing like valuation and DCFs and things. You can instead calculate your what thresholds you need to meet, or whatever, however you want to say it, what returns you think you'll get. Instead of having to come up with a valuation for the business, you kind of buy it as if you're trying to calculate what's the yield on this stock, as if it was the yield to maturity on a bond or something like that.
Do you think that's what he meant when he was talking about how he wants a 15% earnings yield today that he thinks will grow in the future? That's how Alice Schroeder said.
I think Alice Schroeder, I mean, when Alice Schroeder said that, I think she literally meant he wants something that's giving return today and can grow. She was talking about an investment that he made in the 50s, for the first time, and then added some more later. But I think at that point, yes, he wanted 15% pre-tax, which at that time, remember, is only 7.5% after tax, and then to grow after that and stuff. Yeah. So I think that he actually wanted something that was trading at the equivalent today of 13 times earnings and then growing pretty fast.
What do you think he thought about IBM when he invested in this company?
Oh, so that's a really good example. So not a company that was growing.
He invested in IBM in 2012.
Yeah.
For the first time.
And so it just had constantly negative growth and constantly negative gross profit. IBM is pretty classic that way. And I've warned about this with revenue and gross profit, that I like to see it rise a little bit each year. And I think of that the way Ben Graham talked about growth as a qualitative aspect, not a quantitative. It's difficult to calculate mathematically how dangerous it is if the company is shrinking. And that's the problem here. So they were buying back stock and had very high free cash flow. Their returns on invested capital and stuff were probably pretty good at this point. Actually, they might be hard to calculate, but let's see. So you had you had strong returns on tangible capital, right? And then you had a business that for the most part wasn't getting worse. When he bought into it and stuff, it was shrinking down, but it was keeping the good parts of the business and everything. So it might have looked like it was shrinking, but it actually wasn't getting worse as a business. So it was able to increase free cash flow per share, which is the only thing that matters at all, at a really good rate. So, and it had a good return as a stock before he bought into it. So actually, even though it was seen as not a growth stock or anything, it was giving you growth stock type returns, as you can see there. So, free cash flow per share had increased more than 5 times, almost, he bought in what year?
2012.
Okay. So yeah, I mean, it had grown at a pretty good rate, 4 or 5 times in the last decade or So after the turnaround. So that's really good numbers, much better than many actual growth stocks. And it's because they were buying back their stock, and also because they were keeping good businesses and getting rid of the bad businesses. You can see that in things like gross margin wasn't getting worse, even though the company wasn't growing much, stuff like that. But the difference is it wasn't really shrinking consistently till he bought in. After that point, you have a problem. So if you look in the years before he bought in, gross profit, not on a per share basis, but just in general gross profit, every year had increased for a while, actually. Now, not by a lot, but it had increased. And gross profit is what matters more than revenue. See, if your revenue goes down, but your gross profit goes up, that can mean you're just getting rid of useless sales and stuff. So that number's not bad. If you look, he actually bought in at a time in which gross profit growth was, for that kind of giant company, that's fine. That looks like a lot of big brand companies and stuff. So, and he was getting a really good price if we look down at the price. But then what happened afterwards is the problem. And that's why I say like growth is a qualitative thing, because there are probably signs at IBM that there was no growth and that things could get negative because they were so close to shrinking already. So you feel it's a sign of less protection in terms of your competitive position and all sorts of things. It's just like can be a pretty bad sign if you're not able to grow while your competitors are. But I think he bought it purely for the financial engineering. I mean, he did an interview with CNBC where he revealed it and stuff.
Revealed the investment for the first time.
Or maybe it was a different one than that. But one of those interviews, he talked about the fact of, look, if you keep buying back your stock all the time, eventually you're not going to have any stock left. And that, if you look at that row, diluted shares, I think that's what it's all, that's the entire reason for his investment. That and a projection the company made. So the company also said what it planned to do over the next 5 years or whatever. I think those were the two things. So it's buying back 3, 4, 5, 6% a year, every year for, let's see, it had done that 7 years or so before he bought. Every single year it had bought back several percent. So not less than like about 3% a year. That's huge. If the company buys back 3% or more a year, and as we said, gross profit was actually rising a little bit each year. So if you look at the average there, gross profit probably in the, let's say 7 years before he bought in or whatever, gross profit's growing 5% or more a year on average. Shares are dropping 3% or more a year on average. So he's getting a stock at what P was he buying into?
12.
That's probably growing its per share gross profit and stuff by like 8% a year or better, which is what matters. So he's actually getting a pretty growth oriented stock for a giant stock. Remember, he can't buy things that are that big that are growing like 8% a year, but it wasn't really growing it. Like actual revenue stuff is not that strong. Like actual top line growth wasn't that strong. It was okay in some years, but not in others. That's very weak record for a Buffett company. That's like 3 negative years within the last decade. And then after he buys it, it's negative all the time. Very uneven, not all sorts. That's just not a good revenue record for a Buffett company. If we compare it to anything else that he bought at the time he bought it, he's a big on like consistent, predictable revenue growth. So this was a very different company than what he normally invests in. I think it was the business was the problem. I think he liked the financial engineering, the capital allocation, management.
Do you think that is a bad way to sort of start with the business? I mean, if it's not actually continuing to grow and, if you're coming at it from like a financial engineering perspective, is that maybe not the best way to go about it from your experience?
From my experience, it depends. IBM's in a competitive business. He may have felt, and I think he did feel, that their business wasn't as competitive as it turned out to be, because he talked to some people about why their IT departments used it. He said that he talked to people at all the different IT departments at Berkshire to get a feel for why they used IBM. This one is most similar to, I talk about ad agencies, most similar to ad agencies, because although it has very poor growth numbers for a while and stuff like that, it to some extent did not for a long time have a rapid deterioration in the business quality. This is unusual for how companies work. Most businesses are in industries with much more competition. And by the time that they're actually contracting, the business fundamentals are terrible. In a lot of industries, in fact, the business fundamentals deteriorate to the point that profitability and stuff disappears before you end up with no growth. Like you actually maintain some growth even while you're having severe problems like that. So the answer is it depends. I've bought into companies, we'll see if they're mistakes or not, similar to what Buffett did, in that if you buy into a company with almost no growth, certainly no unit growth and things like that, but it has a very strong competitive position, usually that works out. So, and in fact, I've been invested in companies that were taken private. I bought them, very similar situation to like IBM. They're taken private. They've gone public again now. They have huge valuations. They've their organic growth is like nothing. But they're monopolies and they raise their prices every year. So if you have something where you retain all of your customers, you raise your profit, you raise your prices every year, and you don't use any assets, the fact that you can't grow your business because you already have like 100% penetration rate is not a big deal. So if like I've talked about owning IMS Health before, I've talked about Dun & Bradstreet, FICO, some companies like that. At different times, some of those companies have no growth really. Even if they're telling you they have growth, I think they can appear to have growth, but the actual like growth in the US and customers and stuff is not there at all. But they worked out a lot better than IBM. So why? Because I think IBM's position wasn't actually as strong as that. You know, and then though in between examples, like we talk about ad agencies, their growth has been very, very low at times without really eroding their profitability that much because it's probably not that competitive. But it's competitive enough that that digital stuff grows too fast and they haven't been able to grow traditional advertising.
So in 2012, the company did about 16 billion in free cash flow. So he purchased it at about, call it 6 to 8% free cash flow yield. So I would say that's pretty cheap, right? Even on a EV basis, cheap. It's 12 to 13 times.
There's almost nothing that cheap.
It looks a lot like his investment in Apple in a way.
Yeah. So it's very similar. It's an incredibly cheap business, right? For that size. There are businesses as cheap you can find among smaller companies all the time, but you rarely find them among very big companies. So very cheap. And it was very cheap and it had the cap allocation they wanted. That's a really big thing if you combine the two. Really cheap without the cap allocation part doesn't work. Buffett, if you watch, the thing that will most likely make him buy into a business in terms of timing is a change in capital allocation. That's what really attracts him. And like he watches the business forever. He said he read IBM's annual reports for more than 50 years before buying this. He was a reader of it every year because he knew about the company back when it was a big growth company when he was running his partnership and stuff. So he's watching the company all the time. What makes him buy into it? The only two things I've seen is a change in industry economics. I've seen that from him. And I've seen capital allocation, the biggest one being a shift in capital allocation. So like the management gets religion or whatever about stock buybacks and things like that. And so that immediately makes him think about going into it. But IBM is one of those that are, if you look at the financial results though, it doesn't match a Buffett business quite as well.
Why do you say that?
Well, we can look at the past results. They're very messy because IBM was disposing of things and stuff like that. But we've looked at stable businesses before. While stable, it's not as stable as some companies. So like people ask, like, is Cinemark a good business? Movie theaters a good business stuff. They have similarly high returns and better, like less variability and stuff, probably than IBM did before Buffett bought into it. So, not dramatically different one way or the other. But the problem that I see is the revenue growth line. It's very... and the gross profit growth line, right? They're very uneven. And so this isn't as predictable. Now, some things got better, and I think that had to do with disposing of some businesses and stuff. But the variability here is a little high. We have, for a Buffett business, we have gross margins changing by like 10% within the 10 years before we bought into it. We have revenue revenue being negative or gross profit being negative in 4 out of the 10 years or something is something you never see with a Buffett business. He never buys into things like that. Maybe there's some cyclical companies he's bought into, like bought the entire company for Berkshire where that's happened. But I don't know how much of that is disposals of the business and everything. And then as it turned out, you see that it turned into negative revenue for years and years after he bought into it. So it turned out to be a very bad investment that way. Certainly, I think it turned out to be a much worse investment than the actual losses Berkshire had on it, like in terms of how far off it was from what he would have predicted and expected. I think it was a big disappointment for him that way. There's no way he would have bought in knowing what was going to happen in the next few years.
Do you know what year he sold out?
No. It wasn't that long, though.
I was going to say, was it like 2016 or 2017?
Let's see. He kept it for several years.
That's in 2012.
We don't... 2012? That sounds about right then, I guess. I don't know what year he sold out, but yeah, he would have kept it for less than 5 years or something. It was like the Apple one, right? Very big investment. At the time he made it, it would have been Berkshire's biggest investment, right?
Imagine how easy it would have been for him to acquire that stake in such a large company like that.
Yeah, it was very easy.
I mean, he's even talked about Apple before. You were saying, telling me one time off air that he was surprised. Wasn't that Apple, how quickly he was able to acquire
IBM
that position?
is the most surprising.
It was IBM.
Because IBM, Berkshire was buying a ton, and the company was buying a ton at the same time.
That's right.
And they were able to get it. I mean, it was an unpopular stock when he bought into it. Yeah. And it became even more unpopular. Sure.
Let's look at Apple.
Okay.
Okay, so he invested in Apple in 2016. Not 2000.
This also does not look like a Buffett company, but for different reasons.
Really? Why did you say that?
The revenue growth is too fast. So Buffett almost never invests in a company with revenue growth this fast and gross profit growth.
So call it a $603 billion market cap. Now, obviously, it's in the trillions.
Yeah. And Apple's performance as a business has not been good since Buffett bought into it.
That's correct.
I mean, Apple's performance as a business has deteriorated.
If you look at their gross profits
dramatically since like 8 years ago or whatever. You know, unlike some other of the FANG type businesses, which are more, their results are more the same of what they had before.
He said for Apple, he would talk with a lot of, he referenced his grandchildren and stuff. And obviously the iPhone being such a important part of our culture and being on it every single day. And he waited to invest in Apple.
Yeah. So what happened basically, I think, is he was right and the people he was buying from were probably right. Apple was a growth stock owned by growth investors who decided it wasn't going to grow anymore and they should sell it. And they were right. That if you look at the incredible growth rate to what it went down to, on a growth stock, normally that's when you want to get out of it because it has an incredibly high PE and stuff. You need to get out of it at that point. And then often profitability and things deteriorate after that. He looked at it and said, okay, so it's grown all this way, but now it's like done growing or whatever. And now I'm buying into a franchise type company. I'm getting a price that I want on that, like the PE and stuff. So I think they were both right in that way. It would make sense, you'd think, to buy into it when it was growing rapidly. And of course, that's when you had really high returns. But the problem for Buffett is there's no way that you would know that to be able to figure out that it was going to continue to last, right? Like once he knew that people were coming into Nebraska Furniture Mart and things like that and just getting not interested in looking at other Android phones and stuff, but only upgrading from one Apple product to another, then he could buy into the company. But before then, that's not his kind of company. It's not a growth company, right? Mm-hmm.
Yeah, obviously that shocked a lot of people when he invested in Apple. People were saying, is this like an IBM 2.0? In 2016, Apple did $53 billion in free cash flow, and then when he buys it as a $603 billion market cap, I mean, you're kind of right in that, the multiples were super cheap on that.
So your multiples expanded, and then also they had changed their cap allocation. And so that's the huge one. So if you look at why did Buffett buy Apple then, he probably, I don't know why he bought it exactly, because he may have been, like I said, talking, like you were saying, like seeing what his grandkids were doing and talking to people at retail stores that they have and stuff about people's kind of how sticky they were as customers. But the real reason that would attract him to the stock is obviously they started buying back their stock, right?
All the cash they have.
Yeah. Before that, if you look at the years from like 2004 to 2012 or whatever, that's not a company that Buffett would buy. It's growing too fast. Its P multiple is too high. Its diluted share count is rising. It's not buying things back and stuff. It's very unpredictable. It's selling a lot of original equipment, right? It's selling people their first ever phone, their first ever whatever during that period, not getting renewals from people that way. It's just very risky. We have no idea if they'll come back, So that's not a time when Buffett would buy in. He buys in when you see the shift in capital allocation, which is huge. And so multiple expansion and shift in capital allocation is basically what explains the return in Apple. Because if we look, like it's not like their free cash flow has risen a lot or anything like that. It's not from a lot of growth in the company. It's from the market revaluing the company. So where does he buy in? Let's see.
So he bought it 2016 right here, $53.4 billion, and
right.
It's still,
Yeah, but the year before, if you take a 2-year average, they're the same.
Yeah.
So on a 2-year average basis, we don't know exactly what Apple do each year. It's basically the same that Buffett had then and now. So it's not a big difference. And of course, but the share count has dropped, right?
Yeah.
So if we look, the share count is down. So on a ratio basis, if we look at like free cash flow per share, right, we should have we have like EBITDA and stuff, which might be better to look at. EBITDA per share is a little bit more predictive, yeah. So we can see things that should be going up a little bit more generally, a bit more stability in that number over time.
Yeah, you can see the diluted shares right here. They've been declining, call it 5% on average.
Yeah. So that's his return that he's been getting has been the 5% share buyback. And then his actual return, why the stock looks so amazing, is because of multiple expansion.
Yeah.
But that wouldn't have been what he counted on, is that happening that quickly. It's that he's thinking, okay, I'm going to get 5% a year back from the buyback. So in no sense, it's very similar to IBM that way.
Except for they're just having revenue growth, some revenue growth year over year.
Yeah. I mean, I think a big reason why Buffett bought Apple, to be honest, is it's hard to think. He has to allocate a lot of money, a huge amount of money. So if he likes management, if they're buying back stock, things like that, what consumer brand can he buy into that's bigger than Apple? Like, there are consumer brand companies that are bigger, right? But they depend on 20 different brands. Here, what individual brand? He loves things like Coke. When he bought into Coke, it was all about the Coke brand. You know, it had very little to do with their other brands. Gillette. Gillette is not the biggest company around. Procter & Gamble is bigger and stuff, but Gillette is just an amazingly big consumer brand. What's bigger in today's world as a brand than Apple?
Sure.
In terms of like market cap. I don't know if it's the best brand in the world, but it's the biggest.
Why do you think he's never invested in Starbucks? That seems like
He doesn't seem to
I know
do
he
a lot
doesn't
in
like
restaurants,
coffee.
but I would have always thought Starbucks is one.
But he has invested in McDonald's before, correct? Has he?
Yes, and I think he thought McDonald's would be less predictable than it turned out to be. I think a lot of value investors have underestimated how predictable fast food is.
Like QSRs and stuff?
It has no similarity to the real restaurant business. It's just sit-down restaurants.
Because of the nature of how habitual it is for some people? The sort of these intangible
low ticket
qualities?
price, high frequency, and you're making the purchase decision alone. Restaurants are low frequency, high ticket price, and multiple people are involved in making a decision. That's a bad setup for any sort of habit forming thing. Whereas McDonald's is a very good one for habit forming sort of thing. Chipotle is a very good one for that. And so it's a much easier business to predict, I think, is fast food restaurants. Yeah.
Ted or Todd invested in Apple first, and then Buffett started buying it. That was the fascinating thing. Do you think he
bought it on
saw
a huge scale?
So I wonder if that situation was like, okay, I'm going to. Could you imagine Ted or Todd, whoever it was, and then they got sort of this approval from the boss. He starts buying as much as he possibly can as well. I just wonder, what was that like? Did he? Because obviously he sees what they're buying. I wonder if he was like, maybe I should take a look at this, and then from there he went deeper on it.
Maybe. I mean, like the example I would give, the things that I bought, right, is I bought FICO on something that was similar to that. I knew the company. I knew what it had done in the past and stuff. Its capitalization was whatever it was. There was over time of me reading about it in the past and then some changes in management, but they're not things that would have been huge to me. But then they were buying back some stock, and then they were talking about things in a way that I thought, they're going to buy back a lot of stock over time. And then when you start thinking that way, you're like, okay, considering how good this business is, if they really don't do anything else and they just like buy back their stock, this becomes a really attractive investment. And I think that's probably what he was thinking with Apple, is like, don't worry about it as being a growth company and whatever. Like, what attracts you is it being a brand, like comparing it to other things he knows better, I think. And that's why I think when he's talked about like that people, how tied into each day it is, the people's phones and everything, how personalized it is that way to them. Once he realizes how irrational and stuff it is, how it isn't about comparing the features of the phones and things, then I think it can become interesting if you have the right cap allocation. But remember, he knew what cap allocation was under Steve Jobs. Steve Jobs had called him and asked for his advice.
Oh, I did not know that. Tell that story.
About buybacks?
I did not know that. Maybe I read it in the book. I don't recall it.
Yeah, Steve Jobs didn't want to do buybacks.
Why is that?
Because he wasn't a finance person.
Yeah.
He was never going to do a buyback. He wanted to hoard the money and stuff.
Sure.
Yeah.
Okay.
And I think he knew it was irrational. And he probably wanted Buffett to tell him, no, that's okay. It's not irrational. And Buffett told him, no, it's irrational.
It is irrational? He did tell him that?
That basically, I think what investment out there is better than you? There's none. Then buy back your own stock. And then he didn't do it.
What year was that?
I don't know. I hope I'm telling that story right. But yeah, that's what I believe the story is. Yeah. I mean,
I think I have heard that before.
I believe that that's true.
I wonder
now
what
I may
he
be
thought.
projecting onto the personalities of the people involved, because
I wonder what he thought
the
of
motive
Buffett.
that I'm saying for Steve Jobs may not have really been his motive, but that sounds like what it would have been, is that really he wanted to be told it was okay that he wasn't doing a buyback, even though he thought he probably should do a buyback.
Yeah. Steve Jobs probably thought Buffett was a bozo because he's never like created anything other than, investing and stuff like that.
That could be true. Yeah. I also think
He wasn't a nice person.
Steve Jobs.
No, he was not a nice person.
Yeah.
People said he was not a good person.
Yeah. You like that biography?
I really love that book. Very inspiring.
Yeah. So hopefully I didn't tell this story wrong, but I do know that Buffett has said that he actually had spoken, that he, like, because he was asked about something, he said that no, he didn't know Steve Jobs well or anything, but they had spoken, and I believe it was for that very reason.
So we could bring this a little bit back to the pond that we fish in microcaps, and especially less liquid securities. Buybacks aren't really a big part of the pie a lot of the times. I mean, sometimes it is, but correct. I mean, if you're looking at sub $100 million companies,
yes,
very rarely will a company be very focused on buying back their stock. I mean, what are your thoughts on that?
I think that makes a lot of sense not to do that. And I think big companies should buy back their stock more than they do. Sometimes, depending on the company and what the price is. But yeah, you should be willing to buy back a lot more. The growth prospects for very big companies are usually not that great. Whereas the growth prospects for a small company, which can repeat the same model over and over, are pretty good. If you can keep doing the same thing over and over again, then it makes sense, Mm-hmm. Yeah. So like you're looking at MVR now. MVR's business model basically is to option instead of buy. Mm-hmm. So instead of bloating their balance sheet with a lot of land, as other companies do, they try to keep the land off their balance sheet, and then that immediately turns into free cash flow instead of more land. And then they plow that back into buying back their own stock. And as you can see over time, right, there's two models. One model is to have your land item on your balance sheet grow at a rate all the time. We talked about that with like Green Brick Partners or something. Your land per share and stuff goes up. Mm-hmm. Kind of theoretically for a home builder, if you like the areas they're in and stuff, what you would value it on is the increase in land per share. Like how much acreage do I get per share? How many lots do I get per share? And basically how much value in land do I get per share? Because it is a real estate speculation always, like a long-term speculation, but it is. And so you can invest in growing your land by 10, 20, 30% a year or whatever, or you can not invest in land and instead buy back your stock, because then you get cash, mm-hmm. right? So they don't. And so if you look, they generate free cash flow when other home builders don't. And then they use that to buy back their own stock. If they just didn't do the second part, it wouldn't be a very good business. If they just had high returns on capital because they were optioning land and stuff instead of buying it, and so you weren't, you were turning much faster. If you had very high turns, but you weren't buying back your own stock, all that would happen is you pile up cash on your balance sheet.
Mm-hmm. Yeah, and you could see that right here. Look at their free cash flow, and then every year, how much they spend to basically buy back their stock.
Yeah, it's interesting because there's not really a need in home building theoretically for not generating free cash flow, but home builders don't do it because they turn into businesses that own a lot of land.
Yeah, like land banks.
Yeah. And so it's kind of like the idea of, okay, well, should a financial institution originate stuff and then not keep it on their balance sheet? You see that more often. Like financial MVR is unusual in like the degree of innovation in terms of its model compared to other home builders. Whereas like I'd say with things like banks and insurers and stuff, you've seen that some of them said, okay, well, I'm not really going to be in the business of holding the stuff on my balance sheet. And so they experiment with all sorts of different business models over the decades. And that's not something that's happened with home builders so much. Home builders almost always end up holding a lot of land, whether that's kind of their core business or not. Mm-hmm. And then, it is also a question then of what asset would you rather have and stuff. Would you rather just be a stream of free cash flow that you buy back? Or would you rather have a lot of land and stuff? If it was the 1970s, then holding a lot of land wouldn't be as much of a problem because the value of the land would be going up all the time. Like, and the margins were really bad on home builders. And that, like actual home building was very hard to make money. So some of it is also like the environment that they were in. I guess MVR was in a much better environment the last 20 years for doing what they do. than other home builders.
Is a company buying back their stock typically? I mean, is that what you really like to see when you look at companies? If they have excess cash and no need for any other investments?
Of all the things you could screen for to buy an investment today, buybacks might be the number one best thing to see. But I wouldn't run that screen. But the reason why is because it's one item that combines several different things. So if a stock has bought back stock, let's look at NVR, okay?
Yep.
If a company has bought back stock, has reduced its diluted shares outstanding every single year for, let's say, 10 or more years. So they had 1 year that it rose, and then they had 2 during the financial crisis and stuff. So it has risen sometimes. Did they grant option? That might be option.
Probably. On average, it's been going down.
Yeah, but so if they're buying back stock like every single year, or they're doing huge buybacks, either one, it's a very good sign because it means they have free cash flow. It means they think they have financial strength. It means they believe in their business. And it acts, most importantly, as a safety valve to not have declines on invested capital as it grows. Because the biggest problem that most companies have is that if you grow your assets, then you will have declining returns over time. This is something that I mentioned a little bit, but I don't think I think it's easy not to appreciate what I'm saying, which is that it's like one of my biggest warnings. High current period asset growth is the best indicator of poor future returns. That's true for industries, companies, whatever. So yes, we like growth, but if you're looking at a company that's growing its assets, it could be a financial institution, it could be an industrial company, it could be anything. If it's growing 20% a year or something, we like that there's 20% growth because it means we have high returns on capital and we have something to reinvest in. But it's a huge warning sign. It's much easier to go into something to find good opportunities for growth in something that's growing 0% a year than 20% a year.
You know the best example of that, what that was for me,
what?
In I guess my learning process, it's banks. Because banks run into those issues.
Yes.
For their return on equity. So then a lot of times what they'll do is they'll either pay out a special dividend or, do something with that,
right?
The excess cash or whatever. So it was really learning about banks to learn, get a really good feel for what you're talking about.
So banks and insurers kind of explicitly pick those numbers, right? Most businesses kind of don't talk to you about that. They don't say, we need to do something about the fact that we're building up too much equity or whatever it might be. Like how much leverage is appropriate in terms of what we actually need for our returns. Like when people say leverage, they usually think about the riskiness of it, right? But there's the other element, which is if we're not leveraging things up enough, then we're not going to get a good enough return for our investors. Like NVR, if they bought all that land instead of so they had a very capital heavy business, then maybe it doesn't work as well as a business. But a lot of companies won't talk to you about that. It's kind of like, well, we need to do it, instead of showing you the different options that they have that way. So yeah, keeping asset growth down. And that's why when I say things like FICO, Dun & Bradstreet, IMS Health, even things like ad agencies and stuff, why it's a little different for those companies is they're not going to have high asset growth. Even if we don't know if they're going to have high growth or low growth sometimes. So they're much more valuable if they have high growth because they're going to grow their earnings. I think that part everyone's understands and it's easy for them to see, right? But what they may not see is the key thing is that in either case their assets aren't going to grow very much. And that's very different than a cyclical company, which can sometimes grow its assets a lot and then have earnings decline a lot, resulting in very poor return on capital years and stuff. Buffett companies are usually pretty good in having very mild asset growth. He likes the more predictable kinds of companies that have more sustainably high returns on invested capital. And so if you look at even something like when he invested in American Express the first time and stuff, it was a growth company of the era, but was very good growth, very high return, but very stable and more similar to what Coke would be when he bought into that. It's not as high growth as these sorts of things today that we think of as growth companies, which have a bit more risk of a rapid deterioration in profitability. The thing that's most obvious about the IBM disaster for him is that he doesn't normally invest in companies that have seriously deteriorating profitability metrics. That doesn't happen. So sometimes they do grow, sometimes they don't grow. You don't usually see the return on capital fall apart and things like that. Their margins decline, things like that. He usually is able to invest in things that even if they're done growing, like say Apple reaches a very mature state or something, it's not going to be something where he sees big declines in their profitability measures. So their returns on capital and margins and things hold up well.
You could even see from like their EBITDA per share. I mean, in 2000 it was 28, and now in 2019, $268 per share.
Yeah. So I mean, NVR increased everything by a lot because it has the things that you need. So if we look, let's see, we'll do, can we go to top line things like income statement or something? Yeah, okay. So return on tangible capital employed is very high, right? And even in one of the things that's not obvious here is that, but it's very important, is that it actually was very high for the 4 or 5 years or whatever, 4 years, I guess, in which it would be very bad for all their home builders. Because when you look at things geometrically and stuff, yes, it's nice that they had 100% return during the housing boom, but they also managed to have over a 10% return during the bust. And most companies wouldn't be able to do that. So it's important to have both of those. So their overall level is very high. So very high returns on capital, right? And then they did something with that capital. That's what you need to see with all of these the companies you look to invest in is very high return on capital, but you don't do anything with the capital, doesn't work. You need a high return on capital, and then you need to do something with it. And Buffett's talked about that, like when you reinvest or when you use $1 of earnings, let's say, do you get $1 of market value for it? Why I think it makes a lot of sense for a company like NVR to buy back their stock. Some people would argue, well, sometimes don't they buy back their stock when it's too expensive? They might, but on average, it seems to me a better use of their capital than keeping on their balance sheet and trying to do other things, right? Like what else would they do with it? Now, there comes a point where it's dumb to do it if your PE gets too high. But for the most part, if you're buying back your stock, when your PE is, almost anything that they've been at. So even at places where they got up to like almost 30 times or something, it's not that dumb because what else would you do with it? You're still getting better than bond type returns in buying back stuff. You're getting the capital off your balance sheet back to the leverage ratios that you want. And you're not having to do mergers and acquisitions that you don't want to do. You're not having to go into other industries that you don't want to. If you kept it on your balance sheet, not buying back stock, you have to do something. Now, the argument that people will have is, well, you could just pay it all out in dividends. And they could. You could do a special dividend at the end of every year to bring you back down to the leverage ratio you want, which is the other way of doing it. And it's, both of them work. Now, NVR was cheap for much of its period. It's hard to say exactly how cheap at times.
Single-digit PEs.
Yeah, but that was in the years in which people believed there was a housing boom that was irrational. Like, that's an interesting thing. People talk about if you, see here, look. You see the price to tangible book, for instance?
Yeah.
It's very high and then becomes lower. So the question is, which was it cheaper? I know everyone thinks NVR was cheaper in early 2000s and more expensive in the 2010 period. I'm not sure because it was a housing boom. It was a very cyclical stock. So if you look, the stock has a P of 5 or something in 2005, but 2005 is a very irrational period, right? Whereas in 2008, is the stock cheaper because it's so cyclical? That's the thing that you have to keep in mind. Sales is very cyclical too. So I think it's hard to tell with a company like NVR when it's cheap and when it's not. I'm not so sure what periods the stock was very cheap and what it wasn't looking at that. I've never been very sure of that with NVR. I think it was cheaper on average from 2000 to 2010 than it has been lately today. That's a guess. I don't know. But I find it hard to judge. I think it might have been a little cheap sometimes, even in the boom. But I also think it was pretty cheap during the bust then. I don't think it got more expensive, because you can't use PE for a cyclical like this.
I wonder why its multiple basically got cut in half from 2017 to 2018, from 24 PE to about 10 or 11.
I don't know. Some of these are very interest rate sensitive, which is something to keep in mind. Some people are concerned a lot about that. I don't know how the stock's done recently, but most home builders have gone up a lot, which you have to be careful about because while there is a boom in home building stuff, a lot of that's a one-time thing that happens when you change interest rates a bunch. Just like we're talking about with the boom and the bust. So it's not that it's wrong, but you don't want to price it off of just 1 year's PE. You can see, that's the good warning for NVR, right? This is a stock that its highest PE for a year is 5 times its lowest. So the returns you're going to make in the stock are going to have a lot to do with whether the multiple expands or contracts while you own it. So you might own it and think, isn't this great that my earnings per share went up 100% this year in a housing boom? Yeah, but if you bought in at a P of 20 and sell at a P of 10, you've just undone all of that.
Yeah. Yikes. What happens if eventually, I mean, they have, it looks like about 4 million shares outstanding.
You mean they run out?
Let's extrapolate it out to 2050 or 2060. What happens in that case?
Well, they have a pretty expensive stock. So and what's the stock price on MVR? Do you know if the actual price that they use?
Yeah, we can get
they use it.
$3,953.
Yeah. So you split 100 for one or whatever.
And just go and redo it all over
100
again?
for one, right? 100 for one would split them to $40 stock. So sometimes you do 100 to 1 split, so you now have 400 million shares, and then that lets you buy back things. I mean, a stock like this, it's a home builder, so it'll always attract speculative stuff, no matter what, even if people. So I'm sure that you could do that. Yeah, it's a low number of shares. That's another thing is stocks with very high prices sometimes are interesting because it indicates a few things. It indicates usually that they chose not to split, which can be interesting. It could be good.
Why is that interesting?
Because everyone
we were on a call recently,
yeah,
and you asked the person about them splitting their stock in the past, and he was like, "Yeah, that was a mistake. We'll never do that ever again."
Well, that was also I never get why companies do splits that aren't full splits. Personally for me, trying to calculate the past, you can't believe how hard something like a 3-for-2 split or 5-for-2 or whatever the different things that they say, which is 2.5. How hard those are to adjust for in your mind. Or it's very easy if I know that someone did a 2-for-1 split. Like I've seen companies where they do 2-for-1 splits. I don't have to see the adjusted things. I know what year they did it and can see that. Generally, I prefer not splitting because, and when looking for a stock, because it's an indication that they've kind of thought about that. Right. I know that's weird because you think that not splitting your stock.
Because does that tell you that they care a lot about their stock price?
Right. We don't know. I don't know what it tells you, but it's something that's idiosyncratic. It's something that's unusual behavior that they have that for some reason they actually have an opinion about whether you should or shouldn't split a stock. I know that's weird because you would think that just naturally companies would not split stocks. But in fact, the opposite is true. If a stock has gone up a lot over time, it's compounded a lot, so it ends up getting an expensive price, almost by default, they choose to split it. So I think the ones that have very high prices are more interesting. Now, some of them have been reverse split to get to that level, so that's a different story. But it usually indicates that a few things. It indicates usually that they care about their stock price. They do care about it in a sense. But they didn't take the advice that most people give. So for some reason, they have some sort of opinion about it. I don't know what that opinion might be, but for some reason, their opinion is different than investor relations people's and stuff might normally be. And then it also shows you, sometimes it shows you it's more of an overlooked stock. Other things equal a very high stock price is interesting that way. I did do some screening of things a long time ago. And some of the odder things that screened well for finding interesting lists of stocks, right, is a very low number of shares outstanding versus the amount of years you've been public. So if a company like MVR has only 4 million shares out and has been public for a very long time, that tends to be almost an opposite indicator from a promotional company. So for some reason, the company's either been buying back stock, not splitting, doing things like that. So buying back stock, not splitting, and getting older. For whatever reason, that combination of things gives you a very attractive list of stocks of like family-owned things or companies with odd cultures or whatever, versus what seems to be the normal one, which is not public for very long. You go public, go private, go public, go private. Right?
Sure.
Issuing lots of stock and not buying back your stock. So like old buying back stock, not issuing is kind of anti-promotional. Whereas going public and private over and over again, or just being a new company, and those sorts of things indicate the opposite. So it tends to show up lists of like, they're not all owner operator, but they're very different kinds of companies. I think that's the biggest thing because like Buffett bought into Washington Post not long after its IPO. He actually bought into, I believe he bought affiliate publications on an IPO basically. So it's really just a question of like, it's not, is it an IPO or not? I wouldn't mind buying into IPO if no one else showed up,
Yeah.
It's how promotional it is and stuff over time.
Sure.
And so for whatever reason, very high stock price tends to be associated with lack of willingness to just give in to whatever people are telling you about promoting your stock.
You're saying like on a per share basis. So it's kind of like Buffett with the A class shares. And the only reason he did the B class was because people were basically replicating him and selling it as a cheaper alternative.
Yeah.
For people.
I mean, I think
on a per share basis.
I think that holds true in most industries. I think NVR is, compared to other home builders and stuff, high price and is the most unusual of those companies. I think Seaboard in like meat processing stuff is high price and the most unusual.
I've noticed a lot of family ran businesses tend to not split their stock, it seems like.
Right.
Where they control the business and they don't really care. So it just seems like they just don't really ever split it. They just let it run.
Yeah, and it's an interesting question. Why? Are they doing it because they, like Buffett does, he doesn't want to confuse people about it, attract attention to it? We've seen stock splits do it, attract attention and stuff. Is it because they feel like there's no need to do that? It's just fine to not split it. I don't think of it that way because I don't trade my stock back and forth. We in the family own our stock for a while or whatever. Or is it they actually don't want to attract attention to the company because they'd rather own all the shares and stuff? Remember, some families don't want to attract attention to the fact that they're a public company. Some very small companies, I think, don't even let people in the company know that they're public, and they kind of downplay that and stuff.
That's the interesting thing too, especially in microcap land. Do your employees even know that you're public? What do they think about that?
Yeah, so very small companies where there's no incentives tied to stocks sometimes don't know that the company's public. And that's an interesting thing to do. But I mean, I think when the stock performs well, it's not a very big risk for the insiders. So like if the business performs well over time, they're a compounder, I don't find that they're usually that worried about that. But if the business does not perform well, there'll be points where it trades below its value that it could be sold to a other private companies for and stuff. Like it's asset value or whatever you want to call it. It's private owner value. And so when that happens, you'd attract an activist who tell you to sell the whole company. So that's the thing they never want to do. So if you're very undervalued and stuff, you run into that problem. But usually then you don't have a high stock price. So that's the other thing. It's kind of like the buyback thing. A reason why buybacks are interesting and probably attract Buffett is it's an indicator that you have free cash flow and an indicator that you're willing to buy back your stock. If you're buying back your stock, just borrowing a lot of money to buy it back, it's not the same indication. And the same thing here, the very high stock price means you haven't split it, but it also means that you've compounded all sorts of value by a lot, because your stock price won't get high unless you also manage to compound the underlying values while not splitting it. And I think that he's probably attracted to companies that are like buying back stock because it indicates a shift in capital allocation for them, mainly. But I think that can be misleading because I think if he was investing in very small companies, he wouldn't put much emphasis on buybacks. So I think it's a big company. It's more
because
obvious
they're
to
more
us
like
now.
a steady state of free cash flow and stuff like that.
No, just because they have someplace to put the money. You have to, he cares about their return on incremental capital. And so it's easy for small companies to do that. We were talking about McDonald's, right? So you go back 50 years or whatever, it's easy for McDonald's to reinvest. Starbucks, right?
A lot of opportunities.
So there's no need for Starbucks to buy back stock until its last, 10 years of existence. There's never any need for it because it can easily just reinvest in growing the business because the growth rate of the business is as high or higher than the profitability. I mean, I did this calculation once with a bank. We can do it with any company. But let's say a company has a 15% return on equity and it wants to pay out a third of its earnings and dividends, right? Then the question you have to ask is, okay, can it do that? And I think if it has about a 10% growth rate, then that's really easy that we can do the math on that. But when you have companies in which their growth rates exceed their profitability, then you know that all of the profits can be reinvested in stuff that will generate adequate returns for you. But you could run into the problem they need to borrow, they need to do all that sort of stuff. So I always think it's a good idea to compare like the return on capital and the growth. So if we look here, for instance, with NVR, you can see this. So like their return on assets, so after tax return on assets, which is just the lowest calculation that you can do, their actual returns would be higher than that in all sorts of ways, is meaningfully below their revenue growth rate. So they can't grow presumably they can't grow their revenue as fast as their business isn't growing as fast as their profitability. In other words, their profitability is too high versus growth. And you see this with some companies, like I've mentioned this with China, but Chinese companies generally, as a group, Chinese public companies have growth that is too high versus profitability, or profitability that's too low versus growth, which suggests that you need to issue equity or borrow debt all the time, and also suggests your stocks won't do very well. And that's what we've seen for the most part. For China as a country has done amazing. Stock market hasn't done that well. And that's consistent with having poor profitability versus growth. Buffett stocks always have high profitability versus growth, never poor profitability versus growth. So they're not fast growers with lower profits. They're never companies that need to rely on outside financing and stuff to grow. So the reason why they do the buybacks is because they produce too much. I mean, Munger said that's a problem with them in their history. They really only know how to buy companies that are just cash gushers. And so until they could buy the utilities and Burlington Northern, they were never able to find things that you could put things back into. And when you're a small size, it doesn't matter. You can just keep buying things with high free cash flow and do that over and over, right? Mm-hmm. But when you get really big, he runs into this problem. What do you do? And Berkshire itself has not been willing to buy back its stock in huge amounts or to pay dividends in huge amounts. So it had to find things like the railroads and the utilities.
What do you think happens after he passes on? Is there a new capital allocation plan with the business?
Yeah, I think the capital allocation has to change.
Which will be what?
I don't know what they'll pick. But I think buybacks and dividends make a lot of sense. It could be different sorts of ways of doing it, like declaring a special dividend each year or something to get it down to a level. Maybe, the most rational one.
Like, do you think Ted and Todd all of a sudden are going to be managing, the 100+ billion and and making those decisions?
Yes. But yeah, I think that maybe the right thing is to pick a level to say, okay, we need $40 billion in cash at the end of the year or whatever. And to the extent you exceed that, if you use in buybacks during the year, that's fine. If you don't, then you just pay out the rest in a special dividend each year. My guess would be Berkshire would avoid regular dividends. More than most companies would. Regular dividends are kind of against the Berkshire philosophy and stuff in a way that I don't think special dividends are. I'm not a huge fan of regular dividends. I think they're...
Why is that?
Because it's only because of how companies deal with them. But I think they get themselves stuck into a situation where they believe they can't cut a regular dividend.
So kind of like they get stuck in the GE box, if you will, and how they thought about stuff like that.
I feel that they get themselves in a situation where they can't undo it. And that's not necessarily a problem for some companies. Like some little company or something can do that, can have a regular dividend, it's a one product company or whatever, and stick to that all the time. But for lots of companies, there are sometimes opportunities to, do an acquisition, get into different sorts of businesses, buy back your stock, but do other things that would make sense. And they might be avoided because of the problems they cause for the dividend, or worse, the dividend might be maintained even though you want to reinvest in your business, you want to borrow money to do something, you want to do all this stuff at the same time that you're doing it. I don't want reinvestment in the business decisions made on the basis of there needing to be a dividend, You can imagine how dangerous that is.
Sure.
Yeah. I think it's one reason why some companies took advantage of the COVID thing to be like, oh, we can get away from this. Yeah, sure. That we don't have
never
to
reinstate it.
And if you do reinstate it later, then it's like that we can't be blamed for that part of what happened there. So that's kind of that kind of one-time thing, or the financial crisis or something, is different. What I mean is more like something fundamentally is becoming a problem in the business, and yet you stick to doing that,
The most fascinating thing about Buffett's career, and Munger has said this, I think it was 2013 maybe, that really about 10 investments have made his record what it is. And he basically said, take those 10 investments out, and their record was very mediocre, very average, I think is what he said.
Yeah. I was talking to someone recently where I said that I thought my guess was that all of Buffett's value creation came from a few industries. Which I guess you could divide into three things. but they're not industries. They're sort of whole sectors. But financial services, media, and consumer brands. But widening that out, it's all insurance and banking. It's all advertising supported media and advertising, and a lot in publishing, and then you have your consumer brands. But Berkshire's like preserved some money and kept it at sort of like average rates and things by investing in other things. They're in the railroads, they're in the utilities and things like that. Those are big because of how much capital they were able to put into them. But I think all the if we want to talk about alpha and stuff, was all created in really just those areas: finance, media, and brands. With the exception being, we're kind of excluding the partnership years. Mm-hmm. Now, there's still a lot that came from those things in the partnership years too, but we're kind of excluding the early years of the partnership and stuff where it was from all sorts of different things. And I think Munger is too. I think he's saying the Berkshire record really is that way, yeah.
Interesting. Cool. Well, I want to thank everybody so much for tuning in with Geoff and I on today's podcast. The spreadsheets we use, we pull from QuickFS. If you do sign up, tell them you came from Focus Compounding. And be sure to check out our app, focuscompound.com/app, where you get access to our podcast backlog with timeless episodes, and also a additional private premium podcast that gets uploaded on the weekends. I want to thank everybody so much for tuning in. Hit the subscribe button, and we'll see you in the next podcast.